Good morning. It is Wednesday the 14th, and here's today's agenda. Metals march to records. Chinese exports don't need America. And it's Trump versus Dimon on Fed independence.
Let's get to the markets then. Asian stocks are on the front foot, up 0.7%. The Nikkei performing very well again. The yen, the last time I checked, was largely unmoved, but at 159. So continuing questions about yen intervention. European stock futures then, after a little bit of softness yesterday, pointing to very modest gains of 5 points. Silver on a tear above 90 for the first time, up 3.5% in the session. The opening trade starts right now.
Wednesday morning, good morning. The world is a crazy place. How do you price crazy? I have no idea, but the clearest form seems to be at the moment in the metals markets. Silver and gold continue to rally and rally strongly. Silver's up another 3% this morning. Gold continues to tear higher. These are maybe the cleanest expressions of some of the craziness we see around us, because it's so hard to price all of this. How do you price Fed independence? Do I care about Fed independence? How do I price what happens on the geopolitical front? How do I price what happens on debasement and all this it's really hard. But gold and silver seem to be doing it.
Yes, and there's the precious metal side, and then there's the industrial metal side. So taken as a whole, there seem to be risk-on and risk-off reasons to be buying metals right now. So if you're focused on the geopolitics, if you're nervous about Fed independence, maybe you buy for that reason. If you are excited by the Chinese export story, if you're excited by AI, then you buy some of the industrial metals. And so as a complex, as a whole, they're having a really good 2026 so far.
And how do you explain equities at record highs and huge moves into precious metals that usually offer that safe haven status? But as you both pointed out, there's a number of factors driving both silver and gold. Silver, of course, has that utility. Citigroup, in its 3-month forecast, then raising for silver $100. That's their target over 3 months. $5,000 for gold. We come to a big day on the tariff story as well, and we'll get to the details on that. But tariffs is another catalyst for silver. And the question mark is, for me, is what is the downside for silver if tariffs are not imposed as part of this Section 232 investigation that is currently underway in the US, and we should get some answers towards the middle of this year. Is that potentially where silver? It's just one of the catalysts, but it's an important one, it seems, in terms of the stockpiling of silver in the US.
Word to use when it comes to some of these metals, but we'll park the chemistry for one moment. Just size and scope. I was having a bit of fun this morning. Why not? The amount of silver that's ever been produced is currently worth, total amount of silver ever produced, currently worth, in today's number, 90, around 5 trillion. Okay? So that's kind of north of Nvidia. So if you think about the kind of size and scope of what the silver market is currently worth, about more than Nvidia, a little more than Nvidia. However, only half of that is currently recoverable. A lot of silver's been lost over the years, and that means it's probably worth about Amazon. So just in terms of the size and scope, the silver market is probably worth about Amazon, and all the silver ever mined would fit into a cube that would be 55 metres by 55 metres by 55 metres. That's the market we're talking about.
Love that size and scope.
That's very good. It's very impressive. The conversation around metals, though, goes through trade, takes us to our next agenda item, which is around trade, but the Chinese latest trade data.
And look, you touched on basic resources. That ties into the China story. So manufacturing is just on fire in China in terms of exports. But it tells you two stories. It reminds us that the domestic story and the consumer in China is very weak because imports have softened and exports are very decent despite the drop that you've seen in the US. So just the headline number, the trade surplus in China for 2025 hitting a record of $1.2 trillion.
And it accelerated in December. So the December number is up quite sharply, and this is despite the fact that the US number has fallen very sharply.
Fell 30% in December to the US.
As a result of tariffs. That's a staggering number. So where's it all going?
The rest of the world has now got the problem that America deemed it had a year or so ago.
So I look at this number. Do I sell the euro on the back of this number? Okay. So let's just think about trades that you can make off the fact that the Chinese trade surplus is enormous. Do you sell the euro because this is deflation coming into Europe, which is something the central bank, the ECB, is ultimately going to have to deal with? Is that a trade that the ECB... Actually, there's a deflationary impulse in Europe that will force the ECB at some point to cut rates again.
And how much do regulators, governments, want to get in the way of that? And I suppose we've seen that expressed in the auto sector. We've had lots of conversations about the way they want to stand in the way of Chinese cheaper imports. But at the same time, just yesterday, the conversation in the UK was once again about cost of living. And if you're looking for cheaper things, if you're looking for cheaper things generally, and if you're looking to take a leaf out of Trump's book maybe and try and shore up your political support by getting things cheaper, then this might be one way to do some of that.
Because the gains in the export numbers are not coming through from toys and clothes are out of China, being shipped out of China. They're coming through for chips and, to your point, ships, interestingly, and cars. And so that ties into your point in terms of the political response, in terms of potential additional tariffs.
Used cars prices went up in the United States, which I thought was interesting yesterday. The other story on China, which I think is just worth mentioning because it's getting a lot of play this morning in terms of the market, is what is happening on the margin situation. So the Chinese are clear that they do not want their market to rise too quickly. The stock market to rise too quickly. So they've raised the margin number from 80% to 100%, which should, I don't think it's going to stop the stock rally, but it's certainly going to slow down the stock rally. And again, this speaks of a much more managed kind of economy, to your point, China, in China. And you just kind of, you think about kind of the translation into what is happening in other markets.
And it had the desired effect. If that's what they're aiming for, a slower rally, then it had the desired effect today because stocks went from being up by more than 1%, I think, on the CSI 300 down into negative territory, just in today's response. Let's talk about the Fed conversation once again, because now we have Jamie Dimon on the other side of this versus President Trump, if you like, or at least what the DOJ has been doing. So Dimon giving the Wall Street view, the one that we hear a lot, which is that if you keep chipping away at the Fed's independence, that's not going to be positive for anybody, and highlighting that it actually might be self-defeating, it might increase inflation expectations, it might push up rates at the long end. And we've heard this before, we've seen warnings of this. Since the beginning of this week, we haven't necessarily seen that expressed too much in markets, but we have had lots of conversations about how that is the big risk. I'm not sure it's surprising that Jamie Dimon is on the other side of this conversation.
And he's the most, obviously the most prominent in terms of bank CEOs, but we also heard from Jane Fraser of Citi as well, putting out a statement in support of Fed independence, and the CEO of BNY as well, saying an attack on the Fed is counterproductive.
Did you see what happened in New Zealand overnight?
Fascinating.
Yes.
So the New Zealand central bank governor comes out and supports Jay Powell.
Just like all the other central bankers did.
This is part of a statement that was put out yesterday, and alongside the Bank of England governor.
Basically, he's there with a group of central bank, and the government comes out and says, don't do that. Because don't do that, because we're worried about Trump.
Stay in your lane.
Yeah. Trump basically saying, well, we're going to pick on New Zealand because your central banker has supported Powell, who is my adversary. He made that clear again, Amazing.
Yes, I did wonder, when we saw that letter break, I wondered what impact, would this have any impact domestically in the United States, and what risk, if any, were these central bankers running by getting involved?
Jamie Dimon has become the poster boy, in some ways now, for this criticism. He's always been the kind of representation of Wall Street.
Yeah.
But does it make it more likely the Trump administration pursues the banks, i.e. the credit card story? Does it make it more resolute in that kind of action? I don't know. The implications of this are amazing, and how you navigate this, incredibly difficult.
Meanwhile, you started the programme talking about how this is a dangerous world, and we see news this morning that reminds us that certain businesses need more money now.
You made me chuckle as I sat down. You said the Czechoslovak group was a word I haven't said clearly for a long time, but that used to be a country, but now it's an armaments company, and it is going to IPO. It's got significant commitments as a result of this. Just in terms of, if you've never heard of this group, CSG Group, this is Europe's largest ammunition producer. Okay, so this is a company that sits at the heart of the rearmament program that Europe is currently going through at the moment. It is going to IPO. Understandably, it has a requirement, obviously, for more capital. It is also taking advantage, you could argue, of a market that has woken up to the value of these businesses over the last few years. But it's an amazing story to see just the transformation of what was a hugely neglected part of the European industrial complex, now front and centre. And
it feels as if the more we talk about Greenland and the more we talk about Iran and the other areas where the world is nervous about geopolitical developments, it reminds us that even if we were, and it's a big if, even if we were to see peace in Ukraine, that there would be still reasons for Western governments to be spending more on armaments than they have recently.
And on geopolitics, we think of Iran, we think of the oil price, and now we think of a corporate story, not directly linked, but of course when you come to the energy providers, BP and a redhead across the terminal right now seeing a fourth quarter post-tax adjusted impairment charge in the range of $4 to $5 billion US dollars. So there's an impairment charge of up to $5 billion US dollars. This is a stock for you to watch then at 8 a.m. UK time. It was up just about 10%, just shy of 10% over the last 12 months or so. Changes at the top in terms of the leadership, of course, at BP recently. Fourth quarter post-tax adjusted impairment charges, again, up to $5 billion. Underlying full-year tax rate of about 42%, slightly higher than what they had seen. But that's the redhead, is the focus on that impairment charge. They see net debts at the end of the fourth quarter.
Just to be clear, what this is related to, which I think is the important bit here. This is primarily attributable to gas and the low-carbon energy segment, i.e. the renewable segment of its business, which it piled into. A lot of US companies didn't. It piled into and has produced a significantly lower rate of return than was originally anticipated.
And this will be less and less part of the business, one imagines,
Precisely.
under the new management. And that's also probably worth reminding everybody that this is, of course, coming at a time when we're switching CEOs from one to another and perhaps cleaning shop. Let us tell you what is coming up in the programme in terms of the guest conversations we're going to have. Mark Anderson will be with us, UBS co-head of Global Asset Allocation. Also, Ryan Sweet, Oxford Economics chief global economist. We've seen quite a few economists and banks actually dialing back their expectations for rate cuts in 2026 since Friday, since that employment number. So where do these two sit in their expectations? We'll also speak to Sophie Hyun, who's BNP Paribas portfolio manager. That's at the market open. We'll get her perspective. And Sam Lowe will be with us, Flint Global partner, because Tom is just about to tell you that one of the things we might hear about today is from the Supreme Court about trade. And so we'll talk to Sam Lowe about that.
Yeah, that is also on the agenda, as you say, for the day. We'll also get additional details in terms of the inflation story out of the US after CPI, at least on the headline basis, came in looking pretty benign yesterday. Producer prices then later today, 1:30 p.m, building on that story, 1:30 p.m. UK time. We'll break those for you, of course, the team will. And US retail sales also coming out. We have bank earnings, of course. We talked about Jamie Dimon, his comments yesterday. JPMorgan kicking things off with their earnings. And today we get Bank of America, Citi and Wells Fargo. And we will get those Supreme Court opinions potentially relating to tariffs, as Anna was saying later today as well. And, of course, there could be significant market implications of that if, indeed, that comes through. We're also going to be hearing from Fed speakers to get their commentary. Maybe anything they say on Fed independence, of course, will be interesting in the trajectory as investors continue to price to rate cuts this year. And on geopolitics, back to geopolitics, Denmark, Greenland. Interestingly, the Prime Minister of Greenland coming out pretty strongly and saying that they are aligned with Denmark. There's going to be a meeting between Marco Rubio in D.C. and, it seems, some of his counterparts in Denmark and Greenland.
We'll come back to that in just a second. What else do you need to know alongside that story? Bloomberg has learnt that Netflix is working on revised terms for its Warner Brothers bid and has discussed making an all-cash offer for the company's studios and streaming businesses. It's also said the changes are designed to speed up a sale that could take months to close and currently faces quite significant pushback from politicians as well as a hostile bid from Paramount Skydance. The current offer includes a mix of cash and Netflix stock. A US-based human rights group says that 2,500 people have now been killed in Iran. This as the country sees its deadliest wave of anti-government protests in decades. Meanwhile, Washington is considering how to respond following a White House meeting. The US President Donald Trump is urging Iranians to continue to protest against the government in Tehran, warning he would, quote, act accordingly once he knows how many demonstrators have been killed.
Iran says that it will retaliate in the instance of U.S. strikes against U.S. assets in the Middle East. What do you say to U.S. service members about why it's worth the risk to intervene in Iran?
Yeah, Iran said that the last time I blew them up with the nuclear capability, which they don't have any longer. So Iran said that the last time. They better behave.
Oil, steady. But it has seen its biggest four-day gain in more than 6 months over the last few sessions. And as Tom was mentioning, Greenland's Prime Minister has categorically ruled out joining the United States. The leader of the Arctic territory made his preference for Denmark clear in a joint press conference with the Danish Prime Minister. President Trump responded bluntly when asked about these comments.
Now we are faced with a geopolitical crisis, and if we have to choose between the United States and Denmark here and now, then we choose Denmark. We choose NATO, we choose the Kingdom of Denmark, we choose the European Union.
That's their problem. That's their problem. I disagree with them. I don't know who he is, don't know anything about him, but that's going to be a big problem for him.
As Tom mentioned, we've got a Greenland, Denmark, United States meeting taking place today. Marco Rubio leading that from the US side. J.D. Vance is also going to be the US Vice President. What I think is interesting about this is that I do wonder whether we're reaching the limits of what Trump can achieve. And I come back to the Jay Powell story on this. Jay Powell pushed very hard. He gets significant Senate backing. And I just wonder whether a step to try and take over Greenland may be a step too far as well for the Senate. You can hear the rumblings within it. There are There is legislation being talked about that would ban the US from taking action to seize the territory of another NATO member. So I wonder how close Trump is to the guardrails on Greenland.
Once again, exploring the limits of executive power, perhaps, and where that rubs up against Congress and the rest. What's interesting, I think they've got this meeting coming today that you mentioned with all the key players. The signals we're getting from Germany, and Germany's been on the ground already, as have many G7 countries actually in Washington, talking about rare earths recently, but they've been having meetings around Greenland, and the messaging is quite negative. I mean, some of it says, we're confident of a compromise, but some of it, and this is coming from the German foreign minister, the German finance minister, slightly different messaging. Some of the messaging is saying, look, we're not much closer to really understanding their position and not making a great deal of progress on this front.
The Germans and the British coming up with this plan to potentially put additional military assets in Greenland, which just seems to remind us of just what a gulf there is in terms of the thinking of the Europeans versus their US counterparts. This is the Trump administration that wants to take full ownership of Greenland, and having German boots on the ground and UK British boots on the ground that doesn't meet that match. You've also been thinking, I know Anna's been thinking about this as well, as the Danish kroner, and whether you short the kroner in this environment, but of course it's a managed currency.
Managed pretty strongly against the euro, but there has been talk about whether we are reaching some sort of intervention point once again from the central bank, so we'll watch out for any headlines around that. Coming up on the programme, Novo Nordisk CEO is upbeat about the business prospects of the new Wegovy obesity pill. We'll hear from the management there. Plus, we'll also look ahead to today's bank earnings after JPMorgan sounded caution on the White House's demands for credit card caps. What was the overall story from JPMorgan, and what do we look ahead to today on the bank earnings? Up next, metal prices soaring then as markets look to navigate risk to the Fed and to global peace. We will discuss all of that in our next conversation. If you have questions for our guests, please do get in touch. IP plus BBTV Go is the function on the Bloomberg terminal. This is Bloomberg.
20 past the hour. Welcome back. It's the 14th. I'm sorry to sound like a broken record, but precious metals are up again. These are the numbers on the screen in front of you. Silver's having another amazing session. Gold continues to move higher. 5,000 doesn't feel that far away anymore. If you are looking, how do you price crazy? Clearly the world is a crazy place right now. All of the things that are going on make your head spin. What is the clearest form of that? And how do you build kind of insulation into your portfolio? Let's ask Mark Anderson, co-head of global asset allocation at UBS Wealth Management, that question. Mark, good morning. 2026 is off to a crazy start. Gold and silver continue to rally. Volatility in other asset classes remains incredibly suppressed. Is gold and silver the only way that I can price crazy?
I think at the moment that's what investors are doing, because on one hand side, you don't really want to lose out on what seems to be a quite reasonable market rally. I mean, last year we had more or less all assets being up in price, way above their average growth rates. And then at the same time, we're watching what is both geopolitical risk, we got a degree of inflation risk, people are worried about bubble risk. So it does seem like gold is the one that captures most of this. When you put up the chart earlier here with gold and silver prices, obviously, when we started buying into gold, into all of our client portfolios back in 2024, we hadn't expected this kind of rally. We were coming in at the time at price levels of 2,300, thinking we might get above 3,000. And now we're sitting in excess of 4,600 with a target of 5,000 for an ounce of gold. So I do think it's the best portfolio protection we got at the moment, but obviously there's a number of other things that we're trying to insulate the portfolios with. What seems to be an exciting year, 2026.
Mark, but okay, so let's talk about portfolio insulation and figure out kind of where you go with it. Gold, yeah, you got lucky, you bought into gold. Maybe it's luck, maybe it's judgment. I'll park that one for the moment. But why is volatility and everything else so low? Why is the move index where it is? Rates volatility seems incredibly low. Equity volatility seems incredibly. Why is volatility elsewhere so suppressed when gold and silver are doing what they're doing?
I think the main part of this story, and we're investing in a world of probabilities, so there's always a little bit of luck and skill involved with the different things that you're doing. But the real trick is to build this good insulated portfolio that you talked about, guys. So I think the way that we conceptualize it is that whenever you have a world where the global economy is on a relatively solid footing, which I definitely say that it is, we've got some productivity boost and a bit of an exciting story around AI, which we do. And we got inflation rates coming down like we saw yesterday with central banks being supportive. That's basically the factors that drove up equity markets the last couple of years, and that has led equity markets higher into the beginning of this year. So you have to be very, very careful with a lot of these geopolitical headlines we see, because they're not always the main drivers of equity market performance. I think the way to insulate is then to say, what are the types of the bond markets that we can build together with those equity segments? What are the real assets, like it could be real estate, infrastructure, similar, that we can basically insulate the portfolio with, so we're not as exposed to some of these individual risk scenarios that are definitely out there today.
And Mark, are you looking to insulate the portfolio from too much exposure to AI, or are you looking to really maximise or at least increase exposure to that theme? As I know that you've been looking at moving beyond the enabling technologies like NVIDIA and hyperscalers into other parts of the tech stack. So what's the latest thinking there?
So we are definitely into AI-related investments, so both from a whole economic perspective. We think this is a productivity growth driver for a few decades, so definitely not something to be underestimated. We also know that right at this moment, of course, a lot of the action has been around the infrastructure build out, the picks and the shovels, if you will, around AI build out. But we think that the real interesting play over the next 5-10 years is going to be around that application and intelligence layers. So while there might be selective, call it bubbles around individual names, we think that it's about being active. It's something that we've had, again, back to our client portfolios, for a while. It's still in there, but we are very actively picking sort of the right names to be part of that future growth story.
Mark, good morning. The banks stateside got a bit of a hit yesterday, and partly down to the earnings story not quite matching expectations from JPMorgan, but also partly around the credit card cap proposal from President Trump. Do you lean into selling US financials, or is there a buying opportunity there?
So we lean more constructively on global financials. So that's another thing that we've had an overweight to into our portfolios. We think that there is a longer term exciting story that goes a bit beyond some of the, call that current speed bumps or headaches around that potential cap on interest rates for credit cards. But we think there is a story here where global financial earnings have been moving upwards. Return on equity is one of the stronger among the sectors that we follow. And while part of that is in the price in places like the US, we look at something like Europe that also excites us, where we have price to earnings ratios in sort of high single digit levels. That is something that we find to be a buy at this moment. So we'd rather be sort of buyers on dips rather than selling into what might be a little bit of weakness at the moment.
Mark, thank you very much. Mark Anderson, co-head of Global Asset Allocation at UBS Wealth Management. Really interesting to hear from Mark about, the things that we're still investing in. Even the world might be throwing up a lot of headlines, a lot of change, a lot of volatility, but there are still themes that many of our guests are talking to us about around AI that they're still excited about.
But you've got such concentration risk. You look across all the funds that exist out there, all the ETFs, like what are their top holdings? They're AI. Concentration risk is enormous at the moment. How do you manage that, again, in a portfolio? How do you construct a portfolio that gives you some movement around that?
Coming up, we're going to get a view in terms of JPMorgan. Of course, the earnings came out yesterday. We heard from Jamie Dimon saying everything is on the table in terms of that fight against President Trump's credit card cap. We're going to get the details. This is Bloomberg.
Welcome back. This is the opening trade, 7:30 here in London on Wednesday, the 14th of January, and the futures picture. Let's take a look at where we are. Looking for very modest gains at the start of trade. Euro Stoxx 50 futures looking to be up by just 0.1% or so. A lot of focus on the metals story, a lot of focus on the Chinese export story. The Fed narrative rumbles on. Guy, what does all of that add up to when it comes to bond markets this morning?
Take a look, figure out what's going on. Equity markets slightly on the front foot. Bond markets largely unchanged, it seems, at the moment. We are going nowhere in a hurry. The CPI number yesterday didn't move things around a great deal over in the United States. I would just slightly pay attention to the trade data coming out of China, though, and the huge amount of goods that are flooding around the world from China and not going to the United States, which makes me think maybe they're going to Europe, which makes me think that maybe that's a deflationary force that I need to focus on, and that could be something I need to think about when it comes to the European bond market. Anyway, Tom, maybe we go too far this morning.
Well, maybe bank executives are thinking about some of those scenarios as well. Shares of the largest lenders down yesterday after JPMorgan issued an uneven earnings report despite some unexpected misses. The bank's CEO, Jamie Dimon, sounded pretty optimistic in terms of his view on the broader American economy. Take a listen.
If you ask me, in the short run, call it 6 months and 9 months and even a year, it's pretty positive. Consumers have money, there's still jobs, even though it's weakened a little bit. There is a lot of stimulus coming from the one big beautiful bill. Deregulation is a plus in general, not just for banks, but banks will be able to redeploy capital. But the backdrop is also important, but the timetables are different. Geopolitical is an enormous amount of risk.
Let's bring in Charlie Wells at this point to break down all the banking results coming this week. Before we get to the future results later today, Charlie, talk us through what went wrong, what went right for JPMorgan.
Yeah, Tom, look at this drop and you start to wonder what went wrong. Down almost 6% over the past 3 days. And really, one of the answers here was debt underwriting. You take a look at what analysts thought versus what actually happened. There was a surprise drop in the fourth quarter in that business unit of over 2%. Now, analysts had been expecting growth of 19%. So a big discrepancy there. And that really bucking some of the trends that we saw, some of the commentary about deal flow, about investment banking fees that would really increase on the back of that. So that was a miss. That was disappointing. And that took a hit on that share price. But this was this was a mixed report. So if you take a look across the board at these different business units, you see versus consensus estimates, disappointing results on investment banking fees. But across trading, that really was a ballast in this uncertainty. Traders able to beat those expectations of consensus estimates.
Part of the downside on the share price move yesterday seems to be as well what we heard from JPMorgan in terms of the potential impact of a cap on interest rates on credit cards. How strongly did the team come out against this pitch from Trump?
Tom, pretty strong. And there have been some surprises coming out of the White House, a shift in tone on banking, particularly as Trump finds himself vulnerable on this issue of affordability. He's really going after the credit card businesses that a lot of these banks have. So he's calling for that 10% interest rate cap on credit cards and then slamming these interchange fees that merchants have to pay when consumers swipe or tap those cards. Now, the question had been, to what degree would executives counter these measures? Because Bloomberg has been reporting that they have been privately fuming about these. We got a little glimpse of what this might look like from Jeremy Barnum, the CFO of JPMorgan, saying in relation to this 10% interest rate cap, everything is on the table.
And we're also tracking, of course, what the big banks have to say, what Wall Street has to say about the probe into Jerome Powell at the Fed by the DOJ. Jamie Dimon then weighed in on that topic, Charlie. What did he have to say?
Anna, that's exactly right. And would he or wouldn't he talk about this DOJ probe? And Dimon, who's not afraid of weighing into some of these more difficult conversations, certainly did, saying everyone we know believes in Fed independence. And so there's someone who had a thought, who shot back on this. His name is Donald Trump. Let's take a listen to what he had to say.
I think it's fine what I'm doing. We have a bad Fed person. He was extended by Biden. And, yeah, I think he's wrong. I think it's wrong. He's done a bad job. We should have lower rates. Jamie Dimon probably wants higher rates. Maybe he makes more money that way.
So those were Trump's words on Dimon weighing into this DOJ probe. Now, the question going forward, as we get more bank results coming in today and this week, to what extent do executives weigh in as well?
Charlie, thank you very much. Bloomberg's Charlie Wells. Wrapping up what we heard from JPMorgan. He'll be back later in the programme to look ahead to the other bank earnings stories that we have coming thick and fast this week. Let's get a perspective on the US economy, though. Ryan Sweet joins us, a chief global economist at Oxford Economics. Ryan, really nice to have you with us around the desk. Thank you very much for coming in. Let's start with the subject of Fed independence, because it seems to matter a lot to many on Wall Street and could have a real impact on the economy as well. The market, I guess, if you're looking at long-end treasuries and the dollar, has been maybe relaxed about what's been developing this week, but the commentary has not been relaxed on both sides, quite heated. What's at stake for the US economy in this intervening, perhaps, in the way that the Fed sets policy?
Well, there's a lot at risk. I mean, the Fed independence is critical. I mean, there's been plenty of academic research that shows central banks that are politicized. I mean, those economies have higher unemployment, higher inflation, more economic volatility. So this is really at the cornerstone of one of the Fed or the U.S. economy's comparative advantages that we have of clearly independent central bank. I do think this is going to backfire on the Trump administration, and we could see that play out in the first half of this year. Is that the bar to cut interest rates is now going to be higher for the Federal Reserve because they're going to need to build a very strong case to cut interest rates because they don't want to give any perception that they are being politicized.
So you don't look at the political pressure and say that means more cuts. You look at the political pressure and say that means more pushback.
Yeah, probably fewer cuts. I mean, in our baseline, we only have 2 rate cuts this year, and the next one in June. But between now and then, I mean, you're going to have a big bar to jump over for the Fed to justify cutting interest rates because, in the end, they don't want to risk their perception of independence because their, biggest tool in fighting inflation is their credibility.
Okay, let me just put the other side of the argument, which says that the reason the market's relaxed is because the Fed is no longer independent anyway. Like, does that hold water? Because I'm hearing a lot of that at the moment.
No, I don't think it holds too much water. I mean, the Fed's clearly independent. I mean, they're not going to follow what's being communicated from the White House. And, we see we get a new Fed chair. But, I mean, ironically, again, this could really backfire because the president appoints the chair of the Federal Reserve, Senate confirms, but the FOMC selects the chair of that committee. So we could be in a situation where if this continues to spiral out of control, Powell could stay on until 2028 and be appointed the chair of the FOMC.
Okay, let's talk about the data that's going into the discussions around the FOMC table. Are you worried about inflation? What did you make of yesterday's data? Are you worried about the unemployment story? What do you make of the affordability crisis? What do you think about what the kind of the basic economics are telling you about the U.S. economy right now?
Well, in aggregate, the U.S. economy is in good shape.
Right.
GDP growth.
Rate cuts?
It doesn't need rate cuts right now.
No.
Because I'm still a little bit nervous. I mean, a lot of humility is needed in forecasting inflation over the last several years. Inflation still worries me, but I think reading the tea leaves, it looks like at least in the second half of this year, we'll start to see better inflation numbers. Nominal wage growth isn't growing strong enough where you have to worry too much about services. Tariffs are going to run out. The job market, I think, overall, the U.S. economy is doing well, but we're in a jobless expansion where you're going to get really strong GDP numbers, but not.
Are we getting really strong GDP numbers? Fiscal impulse?
Fiscal impulse, but also don't forget about the wealth effect. So, and everything happens with a lag. So
the stock market goes down, the U.S. economy goes down.
That's the biggest risk. I mean, that's where the risks to the U.S. economy have really shifted over the last 12, 24 months. Is that 40% of consumption's with the highest 20% of consumers, and up and down the income distribution, real disposable income is key to driving consumption. But at the tippy top, wealth matters, and that's house prices, that's the stock market. So a 10% correction in the stock market in the past, it hurts. It's a gut punch, but now it could potentially deliver more of a black eye.
Sorry, 10% correction in the stock market would equate to how much move lower in terms of your forecast for GDP for the US?
Probably half a point.
Wow.
Yep. So, but then you layer on the secondary spillover effects, and then you start to worry about an economy that's now just barely growing 1.5%.
Because you're projecting, 2% growth in 2026 for the U.S. economy?
No, we're very optimistic. So
what is your growth projection?
So we have 2.8% GDP growth. So we're at the tippy top of the consensus range. And that's, to your point about the fiscal impulse, throw in the stock market wealth effects, a labor market that's hanging in there.
How much of that is coming, that 2.8% coming from AI and CapEx?
Probably half to 0.75 percentage points. And that's not the productivity gains. We're not going to see the productivity gains from AI for at least a couple of years. This is the direct investment. This is data centers. This is equipment. But I think another narrative for 2026 for the U.S. is that this investment boom is going to broaden out. Last year was all AI. We know AI is going to be growing like a weed this year. But it's the non-AI equipment spending that's going to potentially surprise some people.
Are you at all worried about overheating of something in the U.S. economy? Either the economy itself or the stock market overheats and then we get that 10% correction?
As an economist, I worry about everything. So I am worried about
you're in a good place.
Yes, I am concerned. When you kind of do the alternative scenarios and you look at kind of stress testing the U.S. economy, I'm worried just because the economy is so vulnerable and sensitive to financial market conditions now that if this AI boom turns into a bust, then that's going to be a problem.
How many scenarios have you got at the moment? It just seems to me that there's so many permutations that could knock us off.
Well, you throw a scenario out there, we can create it for you. We've got a laundry list of potential scenarios. So, and they run the gamut, and it seems like clients are more and more interested on the tail risk. You know, by definition, your baseline's in the middle of the distribution, but it seems like, you have to start imagining the unimaginable when it comes to some of these.
Is that where geopolitics reaches?
Geopolitics, concerns about AI is, very top of mind. Partly because of what it means for financial markets, but also, if you look at business investment, it was a lot AI.
But it could happen. You get a 10% correction, right?
Yeah.
That happens fast.
Yeah.
So you wait for something for a long time, and then it happens.
That's a 2-day story.
And that could be precisely. 1929, the US stock market's fallen by 50% in 2 days or something like that.
Yeah.
So there is historical precedent for some really big moves. That would be dramatic. I'm not saying we're going to 29. I'm just saying 10% is the new 50%.
So now you got another scenario running through my head. Corrections are normal. I mean, they do happen, like once every 2 years since the 1970s, but it's got to be persistent. So you got to drop and you got to stay there for a period of time for it to
And would AI be one of the things that would make that drop more sustainable if it fails to deliver? Because you're saying something interesting, Ryan. You're saying that we don't get the productivity gains for a few years. Some people are saying actually they're seeing them already, or they're starting to come through. If we're not seeing those productivity gains and we're seeing a huge amount of capex, is that something that takes us to a bad place?
Potentially. I don't think that's on the horizon. It's just, when does the return on investment, really start to perk up?
But is this the year that we need to find the answers to that question? Or can you defer the answer to that question into 27? Like, how long do we wait for that to happen?
This, in terms of the spend on capex around AI, I think 2026 there has to be a clearer answer, because we've been asking this question for 24 months now. Where is clear evidence of ROI? You say you're not seeing that still in terms of productivity. Or what about efficiency gains when it comes to headcount and jobs? Are you seeing any evidence that the investment in AI is actually improving the bottom line for these companies?
Yeah, so that's one of the big questions that we've been looking at. So when you look at, not to get too much into the weeds, you look at the micro data from the BLS, you kind of look at AI-exposed employment in the U.S., and then we can do a similar exercise globally. You don't see a lot of concrete evidence that AI is causing significant reductions in headcount. It's depressing the hiring rate. I mean, this is one reason why the U.S. is going to be stuck in a jobless expansion. There was a lot of overhiring. AI is reducing the incentive to hire additional workers, multiple job. Some productivity gains in aggregate, but that's not an AI story. That's a very tight labor market and past investment in research and development and equipment.
Say Scotia's throws out the tariffs today. What happens? What do you think happens to the U.S. economy? Can you model that?
We can model. Yeah, so if you assume that it sticks, and I'm very skeptical that would stick, but say the Supreme Court rules against it, that's half a point on U.S. GDP growth this year alone. And that's half a point. So now we're looking north of 3% GDP growth. But unfortunately,
that would be in addition to the fiscal impulse that we're getting in.
Exactly. That's layering on what is already not penciled into our forecast. We assume that if the Supreme Court rules against IEEPA, that the Trump administration is going to pivot to the laundry list of other sections of the trade code, 301, 232, 122, where we essentially get tariffs back up to where they are today. In fact, the risk is that if the Supreme Court rules against IEEPA, it just ushers in another bout of uncertainty.
Why would Trump do that if it wants to solve the affordability crisis?
Well, the Trump administration is a big fan of tariffs. I mean, it's the tariff revenue.
But it also needs to get re-elected in November. And they're worried about affordability. And tariffs, there's some evidence in inflation, but that's a factor, isn't it?
Well, tariffs clearly are showing up in goods prices. And that impact should start to wane in the second half of this year. But if these tariffs are removed, it's the tariff revenue. So if you look at the end game of tariffs, it's revenue. Giving lawmakers in the U.S. money is like giving children a lollipop. Once you give it to them, you're not getting it back. So it's going to be very difficult for them to find a way not to get that revenue.
So the goods might cost more, but maybe Trump's focused on getting you a cheaper house. Maybe that's the focus.
One's the price of lollipops. Ryan, great to see you. Thank you very much indeed. Ryan Sweet, ironically named. Talking of lollipops, nice to see you. Thank you very much indeed. Chief Global Economist at Oxford Economics. Coming up, the other side of that fence, obesity pill optimism.
I'm very optimistic about this pill as we go forward. And again, the single biggest difference, and people have not understood, that this is not a chemical entity, a small molecule, as almost all pills are. Because of that, you have an incredibly potent, effective pill at hand, which we have uniquely learned how to scale it and, of course, make a decent business out of it.
Mike sounding pretty positive there. Novo Nordisk, one of our stocks to watch today. The market open is 14 minutes away. This is Bloomberg.
Welcome back, everybody. This is the opening trade, 7:49 here in London. So 10 minutes until we get equity trading for Europe. In the run-up to that, this is the features picture, looking flat in some places. Let's get the views of Mark Cudmore, Markets Live Executive Editor, of course, who is back with us for 3 minutes on the markets. Mark, very good to have you with us. One of the big areas of focus for, well, since the start of this year, long before the start of the year, perhaps, as well, has been the metals rally. We've seen new highs this year in gold, in silver, in tin, in copper. The list just grows and grows. Seems to be risk on and risk off reasons to be buying metals right now.
I think that's absolutely right. Probably the biggest driver is the attack on the Fed, or at least the most recent big driver. I shouldn't say that's the fundamental driver of the whole move. But the latest attack on the Fed, it continues to get people worried about the idea of Fed independence, the idea that monetary policy will be pressured to be easier than orthodox economics would suggest. That is fueling into this idea to buy precious metals. I wouldn't want to say this is a debasement trade, which is a kind of term we threw about last year, because we're not seeing many other meme stocks, go crazy again. But there's certainly a hint of that in the last 24 hours. We're starting to see crypto do better again. We're starting to see some of the frothier names get a little bit of a bounce again. So maybe if that sustains, we'll start bandying around the term debasement again. But I think this is more about the idea that there's a general industrial demand for some of those metals because of the fiscal stimulus that's been pumped in around the world, and China's economy is still doing okay on that kind of front. Obviously, fiscal stimulus coming through in Germany, in the US, in Japan, etc. And then we also have the attack on the Fed and an expectation the dollar will weaken this year, which is driving precious metals.
Did the Chinese not want their stock market to go up?
I think they want a sustainable rally. I think it's going to be a hard one to get. We've talked a lot on this show, Guy. As you know, myself and most of my team were kind of structural bulls on the China market, or more so the Hong Kong stock market, but that's just a derivative play. We think that's the better play on the China story, but we think it can outperform US stocks for kind of a long term and years to come. I think one of the issues they have in China is they're trying to get out of this boom bust cycle. This is what we saw in Chinese market before. We saw 2007, a big boom, massive crash. Then we saw the 2015 boom, massive crash. They're trying to get a more sustainable bull market. I think they're going to struggle to. I think it's going to be hard with the blow up of the residential market. Now that 16 months ago the Chinese government made clear they're going to sustainably prop up the equity market, and that message was very, very clear and has been correct. People are now starting to get excited that equities is the next boom market, so they're just trying to slow down that bull market.
Mark, on the equities in the same region, 1.5%, another solid day for the Nikkei over Japan. What's the cleanest trade on Japan elections at this point?
It's a great question. To me, look, as you know, Tom, I've been a structural yen bear for years, and I still think that's a trade that's going to keep on working for a long time to come. This is an economy that is permanently stagnant with deeply negative real yields. They can't afford positive real yields, so you're never going to get paid to own the yen because they've got too big a debt pile, and now they're exploding the debt pile. And in fact, there's technical dynamics as well because people buy the Nikkei FX hedged, and as the Nikkei goes higher, they hedge further and they continue to drive that trade and gets a bit of momentum. That said, I'm not sure dollar yen is necessarily the way to play it. I'm bearish the dollar for 2026. So I think short yen and cross is probably the most sustainable way to play it. But I think all three elements do work. Long stocks, short JGBs and short yen.
OK, fantastic. All three elements at play. Bloomberg Markets Live Executive Editor Mark Cudmore. Remember, you can get up to date, of course, analysis and insight from Mark and the rest of the team. Just go to MLive Go on your terminal. Let's get the stocks to watch now with Chloe Millay.
Good morning, Tom. We are talking about Novo Nordisk today because it is on the hunt for some very, very big deals after losing its bid for Metsera last year. And this is an attempt at broadening that obesity portfolio where it's facing a lot of competition. So we should watch out for those shares today after what has been a lot of weakness in the shares for Novo Nordisk. It has lost a lot of investor confidence over the last few months. Moving on to car makers, and the fight over the chip maker Nexperia continues, and therefore car makers are in focus. A Dutch court will consider today whether or not to open an investigation into the Chinese owner of Nexperia. And if it does, then that means that the dispute that really disrupted so much of the auto industry last year will continue, and therefore we could see more disruption there. And that has consequences for all of those car makers. So all of those names up here on the board today will also be in focus. And finally, BP is the last one we're talking about today. It said it expects impairment charges of as much as $5 billion for the fourth quarter of 2025. That is mostly related to the gas and low carbon business. And so we should watch out for those shares after what has been quite an uneven performance for BP as it undergoes this big turnaround effort to refocus on oil and gas. So that will also be a big one to watch out for today.
Chloe, thank you. Chloe Melly there. And we'll focus on miners once again. We've got silver up 3.7%, platinum up. We've got gold higher. We've talked about tin and copper and a whole host of other metals.
So do you buy the London market on the back of that? Is that the kind of the way you trade that at an index level, or does the dismal data coming out of the UK economy at the moment mean that you don't do that?
At this point, we're set for another outperformance for the FTSE 100, if this continues, of course. Do you buy the metals or do you buy the miners is a question as well. There's a lot more coming up. We count down to the open, of course. Futures pointing modestly higher. Stay with us. This is Bloomberg.
Morning, how you doing? A couple of minutes to go until cash equity trading starts here in Europe. What did we learn from yesterday? There were too many ifs and buts, basically, in yesterday's CPI number to have made it market moving. And as we heard yesterday on the show, if it wasn't hot, the market was going to ignore it. It wasn't hot, the market ignored it. So we can park that one. Wasn't that market moving? What was actually quite market moving was JPMorgan's numbers and the commentary around the numbers that we got from Dimon and Barton. The equity market kind of, this is where Europe went out and kind of tried to rally a bit, failed, tried to rally a bit, failed, tried to rally a bit into the close and kind of didn't really deliver very much. So it was a bit of a meh session yesterday in terms of the equity market performance coming out of the United States. Is that going to be the tone going through this reporting season? I think is the question we're trying to figure out. Europe this morning, Tom, what do you got?
Yeah, more bank earnings, of course, stateside coming through, to your point. European futures pointing modestly higher after the sogginess that you flagged, of course, in the session yesterday, looking to add a little over 0.1%, now heading towards 0.2%, slightly brighter. FTSE 100 futures looking to add 23 points. We look at basic resources, of course, in terms of the run-up in prices for everything from copper to gold. DAX futures pointing to gains of just 2 points, with the defence sector in focus again. Anna.
Yeah, absolutely. Defence in focus. We'll focus on the mining sector because we've been talking a lot, once again, about metals going higher, whether that's industrial metals, tin and copper, or whether that's gold and silver. And silver is up by 3.6%. We had a strong day once again for the metals and mining companies listed in London yesterday. Will we see that another day this Wednesday? BP in focus, saying they expect to record a post-tax adjusting item, an impairment charge primarily attributed to gas and low-carbon energy segments. And Novo Nordisk in focus, they're back on the hunt for deals to boost their obesity portfolio. Guy?
OK, here we go. Wednesday session, about to start here in Europe. Let's give you some numbers, tell you what's happening. You've got the silver gold trade to fold in. Defence, we've got an IPO coming out of the Czech Republic on that one. FTSE 100, it's going to be interesting to see the push-pull. Oil stocks are going to be interesting with BP. Miners are going to be interesting with what is happening with the gold, silver, tin, copper, you name it, it's going higher trade. Stock 600, actually not doing very much. You've also got some big things coming out of the States a little bit later on. Think about the fact that the Supreme Court could give us another, it's another day when the Supreme Court could rule on tariffs. So we're going to watch that one very carefully as well. Earnings continue in the banking sector over in the United States as well. Europe is watching for now. We're up by 0.2% on the CAC 40. The IBEX is up by 0.4%, but there's so much potential volatility in the latter part of today's session. I think it's going to be a really interesting day, maybe a quiet morning and a very busy afternoon, Tom.
Unsurprisingly, basic resources at the top of the list in terms of the sector-by-sector breakdown. 0.9% is the gain there so far. The biggest losers on your sectors, insurance so far down 0.7%, but also energy Oil prices, of course, have stabilised, at least in the last 24 hours or so. Energy, then, as a sector, down 0.2. BP, of course, is in focus. That's one of our stocks to watch, and we'll zero in on that shortly. Anna, what are you looking at?
Yeah, I mean, basic resources is that theme of the morning. Once again, we're seeing that sector do really well, as you say. Tom, so we're up by 0.9%. The likes of Fresnillo, of course, have been doing really well on the back of the precious metals rally, and that continues to be the case for the sector. Yeah, Fresnillo is the best performer there. Glencore just underneath the hood. Interesting energy on the back foot. We do have a slightly weaker oil price. So for all of the devastating rhetoric around what's been going on in Iran, the oil price is quite subdued, 64.95 as it stands. Perhaps just waiting and watching, waiting to see what developments come our way on that particular front. So energy names, as a result of that, as you say, Tom, are a little bit weaker this morning.
OK, let's get a market perspective right now from Sophie Hume, who's standing by, portfolio manager and strategist at BNP Paribas Asset Management. Sophie, good morning. We started the show at the top of the first hour by outlining the number of risks facing these markets. What is top of mind for you as you look at all the different factors influencing these markets, the complexity, the uncertainty? What for you is the key driver right now?
The key driver for me is, in terms of global portfolios, the inflation story we're going to have this year, but whether or not the ongoing reflation trade that is being priced by market is really going to start materializing in terms of like hard and soft data in the first half this year.
The reflation trade?
Yes.
It's specifically with a lens on which jurisdiction?
So I think globally, if you look at, I think it's broadly consensual now. If you look at the macro story that broad consensus have for this year, but we started to have sign and green shoots of that late last year in terms of like through PMI, new orders to inventories, with a pickup in some of the soft data, but also some of the very interest rate sensitive countries like Sweden or Australia. I think what we're waiting for the first half this year is whether the positive fiscal impulse we're going to see across the board is going to start impacting the hard data. Because for now, the market has been front-loading this macro anticipation, but we're still waiting for...
Isn't there... We got the trade data out of China today, and just a reminder of the strength of that export engine. Is Europe facing a wave of deflation from China?
I think it's very consensual too. I mean, everyone is talking about this. It's clear that the exporting sector has been quite supportive for China. It remains to be seen how much inflation they're really exporting. What I think we need to differentiate in terms of goods is, you have cheap goods that are getting out of China, but at the same time, China is also becoming an innovative engine, and we shouldn't underestimate it.
Yes, it seems the Bank of England also seeing evidence of this flow from China. The Bank of England's Alan Taylor out with a speech today, and part of that saying that he sees substantial trade diversion into the UK, which one assumes is cheap product coming from China. So in terms of the Chinese opportunity, though, and Chinese stocks, are you seeing an opportunity there? Because we've seen the other news flow around China is increase in margin being required to trade equities in China, and that has dampened appetite just today, but maybe that was the point. I mean, what are you seeing more long-term in the China story?
Long-term China, we're still positive, so we've been long Chinese equities since October 2024. It's been an amazing trade. We've been long A, H, and China Tech. So we took H shares, we're still long A and China Tech. I think there's basically two stories. The first one is the fact that the equity market has become wealth creation, engineering for the future. So if you look at an urban household balance sheet, it's 50% real estate, 30% cash and deposit, and only 20% stock and funds. What we expect is the equity market to basically replace real estate. And you saw a record creation in accounts.
Okay. Well, that's a really interesting one, because that is interesting, isn't it? Because if we've been talking about how the property sector has been weighing on the domestic demand story in China, Tom, and now if you see a replacement of the property sector with the stock market and create wealth that way, maybe that means that the import story turns around.
And up until recently, to the point that Sophie was making, that the equity market in China has not been providing that ballast. Of course, people will burn after 2015. 50% of a family's portfolio is still in the real estate market, which is down for 4 straight years in China.
But the Chinese like to speculate on things, and You have been speculating on the housing market. Is the stock market next, to Mark's point that he was making a little bit earlier on, and therefore how much further could this go in terms of the stock market? Yeah, precisely. But the Chinese now clearly signaling with the margin story, trying to manage that this morning and trying to work that one out and see if they can slow that down a little bit. The other, I'm fascinated kind of how this all fits together. Is the trade on Chinese goods coming out into the rest of the world, particularly going into Europe, the UK, to Anna's point, is the trade there that we're going to see the Bank of England cutting more aggressively and the ECB cutting again? Are we mispricing interest rate futures in Europe?
So, to some extent, I think if you look at the growth outlook for Europe, you have fiscal stimulus in Germany that is going to have spillover effect all over Europe.
Sure.
The growth is going to be resilient, and yet I think most economists on the street forecast inflation to surprise to the downside.
Yeah, because of China?
And ECB cuts.
Because of China?
I think there is, to some extent, China and the fact that you have some deflationary on the good side, but we're still waiting for signs of consumer spending their cash in their banking account, but also the fact that the services inflation, to some extent, has been really muted.
Okay.
So waiting for the reflation to take...
do I position for the fact that the Bank of England is going to have to cut harder and the ECB is going to have to cut again? Is the market mispricing that at the moment?
It depends on your growth outlook. Like our in-house outlook for...
What's yours? Do you think they're mispricing it?
So if you look, like for me, UK, I prefer to be long UK stocks because they are exposed to energy sector, they're exposed to basic resources, which I think makes sense in the context where sterling is still cheap.
And is 2026 a year where you follow fiscal stimulus then, Sophie? Because you've talked about Germany. We know that the US is going to see some of that. Is that going to be an investment theme that you can track in 2026?
It's a story for the first half of this year, and that's why we're starting to see a rotation into cyclical versus defensive. If you start to have like yield higher across the board, but I think the extent to which the reflation and the rotation is going to go, I think remains to be seen. I think we're, to some extent, maybe a bit underestimating the inflation story for this year. There's going to be at some point where the reflationary story is going to translate into inflation surprising to the upside, and I'm just wondering how much portfolios are hedging against this.
And I wonder what that does to earnings and margins then, and whether or not we look back, Sophie, at 2026 and say this is the year when the equity market concentration started to broaden out in a sustainable way.
But that started already in Q3, so if you look
at that continues.
Yes, so I think that's why the Q4 earnings season is going to be great because we're going to monitor it to see if there's going to be a continuation of the broadening out of earnings. But it's already a bit backward looking because if you look at the fiscal impulse we're going to have in the first half of this year, it's going to have a boost on earnings, but then how much consensus is going to move versus the actual delivery.
Is everything expensive or are some things still cheap? And if so, what are the cheap things?
So last year was a bit easier because the cyclical laggards like energy stocks, basic resources was really cheap and that was a way to buy it. I think to this point it basically continued to play momentum because your positioning indicators are not flashing red. There's no exuberance yet. But the fact that gold is still bid in a context where you have this reflationary story means that, you know, people are starting maybe to feel a bit uncomfortable.
So, and cyclicals is a theme for you. Where specifically?
So cyclicals, it's basically this barbell portfolio we have. So you need to be exposed to AI, and we're long Korea, we're long semis. But you have this pocket of the portfolio where we're long cyclical laggards. So we added basic resources, energy stocks in Europe. But on the FX side, being long Aussie or the Swedish krona, which are high beta currencies that benefit from this broad economic backdrop, will perform well too.
What's your view on the dollar for 2026? Because as we think about the earnings story, of course, European earnings were strained by euro strength. If we get, of course, a reversal of that sentiment, that could be positive, the earnings story. But what happens to the dollar? Is there further weakness, or does a lot of the uncertainty being priced in, or does the Fed story just derail prospects for the greenback?
So on the dollar, for one thing is sure, the U.S. exceptionalism has been fully discounted. The dollar is now trading in line with interest rate differential. The the outlook for the dollar this year, I think, is going to depend on how resilient the U.S. economy is going to be. At a time where positioning is already very on
So it is more about
side.
the economy rather than concerns about Fed independence, de-dollarization. It's still about the economic fundamentals when it comes to the greenback.
I think so, because if you look at global portfolios, what's different from last year to this year is we started 2025 with portfolios that were overweight U.S. assets. 2025 post-Liberation Day was the great rebalancing where portfolios have been much more diversified. I think this year we're starting with a more diversified portfolio. People are aware of the Fed independence. And that's why I think when we start to have headlines about Jerome Powell and so on, you got barely any impact on the market, right? So US exceptionalism premium totally discounted. Dollar is going to be much more trading in line with how resilient the US economy is going to be.
Okay. Sophie Wynn, nice to see you. Happy New Year. Thank you very much indeed for joining us. Portfolio manager and strategist at BNP Paribas Asset Management. Let's take a quick look at where we are with the Core 6 this morning. Some of the names that we are watching. Rheinmetall fades a little bit. The chip story fades a little bit. Schneider's doing absolutely nothing. It's interesting that we talked about the tin can trade yesterday. Nestle, I'm not sure it kind of is part of the tin can trade. Maybe it's part of the chocolate trade, is up this morning. So maybe that staple story continues to come to the fore. Novo, Mike Dubstar talking about the fact that he's looking for big acquisitions. Do you sell Novo on the back of that? It's a fantastic run recently, that stock. And you've got this big conference that's taking place at the moment. I think the big theme that everybody's looking to come out of that, I was talking to Sam Fazeli about this going into the conference, the JPMorgan conference, was, are we going to get M&A? And Mike's certainly pointing us in the direction.
Well, they got dry powder, haven't they? Because they missed out on that acquisition. They lost to Eli Lilly. So the reporting suggests that they are looking, Novo, for
Where do you
those,
buy, though?
for those
what do you
acquisitions.
buy? What kind of stocks, what kind of businesses do you want to be in if you are Novo at this point? And how do you buy something that's complementary and kind of fits in with the current portfolio?
Still all seems to be about the obesity story. Let's check in on some of the individual stocks that are on the move this morning. Chloe Melly has a breakdown. Chloe.
Good morning, Anna. Miners are once again having a really good day, and that's because the metals rally is continuing. We have got gold, silver, tin, copper all hitting record highs. Investors are betting on more US rate cuts, and the geopolitical tensions that we've got at the moment are also helping quite a lot, and therefore we are seeing some positive movement, some green everywhere for those miners today. Fresnillo, Glencore, Antofagasta all in the green this morning. Moving on to EssilorLuxottica, which is also doing quite well this morning, up about 2.3% after being raised to a buy rating at HSBC. And it's also because Meta and Essilor are discussing plans to double production capacity for their AI smart glasses because of really strong demand. And so those two things are boosting that stock this morning, and we are up for Essilor. It's not as good of a story for airlines because Lufthansa and Air France were both cut to an underweight rating by Barclays, and we are seeing that reflected in those shares this morning. And we are down in particular for Air France a little over 3%. We are also down for Vistry, which is a UK house builder, which said this morning that home sales in the UK had dropped in 2025 because of this budget uncertainty, and we are down more than 4%. And this probably doesn't bode very well for the rest of that house building sector that will be reporting over the next few weeks. And finally, let's end on a positive move with the Belgian investment company D'Ieteren, which was initiated at a buy by Berenberg, saying that this is a company with a good portfolio with a potential for long-term value creation. And so we are seeing a big boost in the shares this morning on the back of that upgrade.
Okay.
Chloe Melly, thank you very much indeed.
We both were thankful.
Very thankful, always. Coming up, Czech defence and ammunition manufacturer CSG announcing plans to go public in Amsterdam in what would be Europe's largest ever defence IPO. We bring you the details next. This is Bloomberg.
This year, the first year, by the way, in 26, really to get money, and the first 100 billion of Germany, yes, was a very, very small peak. Now the big peak is coming, 800 billion investment. This is huge for Europe, and the industry is acting because we build up the capacities.
Rheinmetall's CEO speaking to Bloomberg. that defence company, its share price has had an amazing run over the last 18 months. One defence company that may be looking to replicate some of that, and firmly in focus this morning, is the Czechoslovak Group, or CSG. It's a Czech company. Czechoslovakia, I think, went away quite some time ago. But it has announced plans that it will be going public. Main listing will be in Amsterdam. Bloomberg's Charles Cable joining us now around the table to talk about this. What is it that it wants? What is it? Defence companies are incredibly valuable. What is the advantage for CSG Group of going public? What does that bring for this business?
So I think the really interesting thing about this IPO is that it sort of covers all bases, right? So they said they're going to raise 750 million euros. So that's almost the primary reason for capital markets, to raise funds. Yep. And then we also know that their main shareholder, Michal Sternad, is going to be selling a significant chunk of his shares. So that's the second reason for capital markets, for shareholders to liquidate some of their ownership. But then there's also the credibility point. And if you are a defence company, you are looking to do business with governments. And if you are a government, then doing business with a publicly traded company, one that has to go through quarterly reporting and all of the restrictions and the rigmarole that comes with, then that helps you have a little bit more trust. And I imagine in the defence business, trust is really quite important.
That's interesting. Dealing with an industry where there's a lot of startups as well, so maybe we'll see. Maybe this is the start of something. We'll see more of it. The company's planning to own around 15% of the shares. Is that going to affect investor appetite? I mean, that's a small free float.
It is a relatively small free float, but I think the thing we need to keep in mind is that this is a really big company. And so the deal size itself is reported to have been 3 billion euros to 4 billion euros in size. We're going to get a little bit more information on that over the next few days and weeks, we expect. But there is only so big a size that the market can take right now. What we can expect, or what we could potentially look for, looking at other companies as a track record, is that the majority shareholder might continue to sell down his stake. And so as Michal Sternad may sell more shares, and we don't know whether he will or won't, but that would increase the free float, it would increase the liquidity. For now, it looks like it could be enough to get into the stock 600. I was looking this morning. It's not quite as simple as having a set free float, but that is one of the most important reasons why you need a certain amount of shares trading.
Yeah. It could be an overhang on the stock to start with, though, couldn't it? The expectation that maybe that will happen in the future. What is
the M&A strategy? Do they have an M&A strategy? How clear is that? Global expansion? We've talked about how significant they are in terms of supplying Ukraine. What is the roadmap from here?
Yeah, well, look, there are a couple of things there. So one, they have said an end to the war in Ukraine does not mean an end to their business at all.
They do ammunition, right?
Yes, they do ammunition. They supplied armoured vehicles as well. Yeah. They have all of these different businesses. They say that this does not affect their business as a whole. What they do say is that they are looking to make acquisitions and they want to become the largest defence business on the continent. They are very ambitious with that. And they have made acquisitions in the past. They've been getting into unmanned aerial surveillance. They've been buying some arms manufacturers, the Kinetic Group. And they have been slowly growing their business using what is probably a once-in-a-generation change in their business from the war to funnel that cash into building out their business.
Talking of generations, who is this main shareholder?
He's an interesting guy, right? So his name is Michal Sternad. He's 33 years old. That, for context, is just 2 years older than I am. So I've still got time.
That context is important, Charles.
But he, he's made a name for himself in the Czech Republic. He is a billionaire, and once this deal is complete, he's going to have a lot more cash.
He inherited the business, though, didn't he?
He inherited the business from his father. His father started it by retrofitting tanks from the Soviet era, and he has built it up over the last few years. He inherited it when he was relatively young, and
21.
21, exactly.
That's not relatively young. That's very young, I suppose, relative to where he is now.
Does that come to the credibility story, I wonder. I don't want to be ageist, but, you know, it helps when you're a young CEO. If you're publicly listed, you have that scrutiny, and you can reassure your investors, you can reassure governments that this is credible, sustainable, and that you're managing the business in the right way. But his biography is incredible, isn't it?
It is absolutely incredible. And what I'm going to be looking for, and what I'm really interested in, is how he's going to use the cash that he's getting from this IPO and what he's going to be doing with it. He has been, in the past, buying football teams. He has a luxury cars dealer. So he is clearly building out his own personal profile as well.
Charles, thank you very much. Charles Capel with the latest on that defence story. We need to talk about mining.
Yes, because defence and industrial firms like CSG may find themselves paying more for metal supplies. Of course, that's been a key theme for us this morning, with both precious and base metals soaring. Joining us for more is Martin Ritchie, Bloomberg's metals and mining reporter, standing by in Shanghai. Martin, what is going on? Where do we start? What is your? Are you most focused right now on the precious metal space or the base metals, in terms of how excited you are about what's going on in the session today? What is drawing most of your attention?
Very excited across the board, Tom. Look, there's a lot going on in the metal space, and you know, I think we were trying to sort of draw a kind of common denominator amongst everything, because today we've had copper, gold, silver, tin all smash up to new records. So it's been, you know, quite a day. There's obviously sort of particularities to each of these metals, but when the whole complex is rising like this, you kind of have to look for commonalities. And I think, you know, one of the things is just we're heading into, you know, deeper into the Fed's easing cycle. Still everything expecting more cuts next year, which should juice economies and the manufacturing cycle a bit more. But beyond that, we've also got the debasement trade still kind of in the background, which was obviously a big driver of precious metals last year. And that's still sort of lingering over into this year. And I think that kind of idea that the currencies such as the dollar, fiat currencies, are less attractive is definitely feeding into investor sentiment, and particularly in China.
Martin, I've got 45 seconds. Why is tin higher when there seems to be lots of tin?
It's a very illiquid market, so it's a very thinly traded market, so it is kind of prone to these cycles of very sharp volatility. There's also been supply constraints from Indonesia, which is one of the major producers, and it's not clear whether those have been resolved as yet. And I think that, compiled with demand from AI markets, is sort of attracting a lot of new investor interest at the moment.
Martin, thank you very much. Bloomberg's Martin Ritchie with the latest on the metals story, one we continue to track in 2026. We also continue to track the trade narrative. Coming up, we look ahead to the US Supreme Court opinion due today. It might be about President Trump's tariffs. We don't know if it will be. It wasn't last Friday, but we will see. We'll have a conversation about what we could get. This is Bloomberg.
Welcome back. This is the opening trade. We are 30 minutes into the Wednesday session. We've got data coming out of the US later, producer prices to build on the CPI that was pretty benign yesterday, and then a continuation of the earnings story coming through from the banks. It's a brighter session in Europe than maybe you would have expected. A bit of softness yesterday, down about 0.1% across the benchmark right now, gains of 0.3. We'll see if that holds. Over in Germany, the DAX is gaining just 22 points, so it's a bit of an outlier. There's more strength coming through from the French pitch. CAC 40 is gaining 0.5%, a pretty decent session over in France so far. The FTSE 100 lifted by the basic resources story. Defence stocks doing quite well again as well, up 0.3 on the FTSE 100. Guy, what are you looking at?
What is interesting is that in so many ways this is a world that is being dominated by macro, and you saw that in terms of the performance of the macro traders last year. But today feels like actually there's some quite interesting single stock stories out there that are worth kind of paying attention to. And you've got 353 up, 229 down, volume's fairly decent. I'm not sure that tells you very much, but actually some of the single stock stories I think are quite interesting. Now, Fresnillo is obviously one of those stories. We talked about it a lot last year, we continue to talk about it this year. Gold miner continues to do well, up by 0.8%. Are the gold miners still behind the trade when it comes to the gold story that we're watching? Kuehne + Nagel, that's Kuehne+Nagel, is up by 4.86%. That's on an upgrade this morning, so it's moving on the back of kind of very specific single stock story news. And the story around what is happening with the staples continues to be interesting as well. Like Nestle seems to be catching a bit at the moment. Others are in that space that are also catching a bit. Sort of chocolates, food. Some of the brewers are doing well. Those kinds of companies seem to be trading better at the moment. What isn't trading better is ASML, which is interesting on the downside. So that chip story beginning to fade a little bit. Had a really strong start to the year, beginning to fade. Novo is down. Mike Dusa talking about the fact that he wants to make a big M&A acquisition. He's looking for that. This is at the JPMorgan conference. That stock's down by 1.2%. And BP out basically saying, actually, we're going to have to take some impairments when it comes to our gas business and more particularly our renewables business. And that stock is under pressure. But there's a little there's an oil price story into that as well. So it's a little bit macro and it's a little bit kind of bottom-up single stock stories that we're watching quite carefully today. But it's interesting. There's interesting things happening. Anna, what do we got?
Yeah, let's get an update on some of the other news flow we're covering this morning. Greenland's Prime Minister has categorically ruled out joining the United States. The leader of the Arctic territory made his preference for Denmark clear in a joint press conference with the Danish Prime Minister. Those remarks come ahead of a meeting between the Danish and Greenlandic foreign ministers with the US Secretary of State Marco Rubio and Vice President J.D. Vance later today. A US-based human rights group says over 2,500 people have been killed in Iran as the country sees its deadliest wave of anti-government protests in decades. US President Donald Trump is urging Iranians to continue protests against the government, warning he would act accordingly once he knows how many demonstrators have been killed. And the US Supreme Court has another opportunity today to rule on the legality of President Trump's trade policy, which relies on the International Economic Emergency Powers Act, or IEPA, for its sweeping ability to put in place tariffs. Bloomberg Intelligence maintains a 60% chance that the court rules against these IEPA tariffs, which cover the reciprocal duties and the fentanyl-related levies imposed on Canada, China and Mexico. Tom.
OK, let's get more on that story and bring in Brendan Murray, who leads Bloomberg's global trade coverage. How did we come to that calculation? A 60% chance a Supreme Court stacked in Trump's favour rules against him on tariffs?
Yeah, I think they're probably looking a bit at the prediction markets that are showing a much higher odds of the president taking a loss here, and some of our own analysis that maybe there are some of these tariffs, particularly the fentanyl ones on Canada, Mexico, and China, that the Supreme Court might give Trump a pass on. But either way, it's Groundhog's Day again. It's we're looking at the same situation as we were last Friday. Opinions are on the docket, but there's no guarantee we're going to get one on tariffs. But the message from the White House has consistently been, we think we're going to win, and if we don't, we have a backup plan. That backup plan will almost immediately start with a new authority called the Section 122, which means 15% tariffs across the board for all countries for up to 150 days.
Details are going to matter here, it seems. Do we get rebates? Do we not get rebates? Kind of all of that kind of stuff feels really important at this point. How is that bit going to be decided? There's a kind of big picture story, yes, no, but then the nuance matters, and I'm wondering where the big contentious points are that are going to decide that bit.
Yeah, exactly. I think you can start with what's the vote tally going to be? Is it going to be 9-0? Is it going to be 6-3? Is it going to be close? Is it going to that will sort of set the tone for President Trump's response. If he's resoundingly defeated here, that's going to be a big black eye for the administration, and they're going to have to scramble. The details in terms of the Plan B that they're going to have to come up with will be important as well. The other authorities that they plan to use, the 301, the 232 that are already out there, how quickly can they get those up and running, the investigations going, the public hearings that they have to have. Some of those will take time, and there's a process. That's why Trump likes the authority that he's used already, because it's immediate. He can send it out in the middle of the night. And so they're going to have to go, if they lose this case, to a much more deliberate, slower pace, but one that maybe won't solve the uncertainty issue. It will just layer more uncertainty on top of the economy.
Brendan, I was going to ask you for a step-by-step guide to what happens if the US administration is ordered to cancel these tariffs. But is it possible to know step-by-step? I mean, we don't know how President Trump is going to react around these other tariff options, for example. We don't know if there are going to be refunds required. what clarity do we have?
It could be fairly immediate. I don't know if it's going to be hours after the decision. If it goes against the administration that they announce this 122 authority, it could come the next day. But we expect, and our reporting from Washington it guides us to believe that this is going to be, they are going to layer, they're going to replace the IEEPA tariffs fairly quickly, whether it's all in one announcement or kind of rolled out in the days that follow. We don't know yet, but they definitely have a plan, and they feel that the tariffs are going to be a part of the administration's policy in one form or another.
Brendan, great stuff. We'll look forward to the coverage a little bit later on. Bloomberg's Brendan Murray on the trade story. Let's carry on the conversation. Sam Lowe, trade and market access partner at Flint Global, bring us his insight into this story. Sam, what do you think the day looks like? Say the Supreme Court comes out with a ruling on these tariffs today. Walk me through the rest of the session. What does the day look like once that ruling is out? How quickly do things change?
So I think the big question still is actually whether they are going to rule on the tariffs today, insofar as it is possible that they rule today. But I've been reading analysis from Supreme Court watchers that suggest that this could run till June. So we could be repeating this conversation over and over and over again, which in and of itself creates a degree of uncertainty, which is quite challenging to deal with. If the Supreme Court does rule against the tariffs, I mean, there's a question as to when that ruling would come into force, whether it would be immediately that the tariffs would be removed, or if there would be a slight lag. But I mean, it's difficult to disagree with what Brendan's been saying in terms of the different options available. I mean, I would add some different approaches that could be taken to ensure that tariff coverage is still spread across the economy. We already have the steel and aluminium and copper tariffs, where there's the option of including derivative products. Those derivative lists have been built up over time. They could be expanded further so that the steel content or the aluminium content of pretty much every product faces a 50% tariff. But I think what we're going to see is an incredible amount of uncertainty if these tariffs are struck down, because we know, again, that we're not going to be sure of the different legal instruments. We're not going to be sure of the tariff levels. And we're also probably going to see some products slip through the gaps over time, which could create some new opportunities.
Sam, we've seen Chinese trade data out this morning, and that trade data signals a huge drop of goods entering the United States. If the Supreme Court rules against the United States government in this case, how do the Chinese respond? What do the Chinese do? How does this change global flows? Does it change global flows? Is there a kind of obvious answer that you can give me? Or again, is it going to be really nuanced and it's going to be difficult to determine?
So I'm not sure it would have such a big impact on Chinese trade flows into the US, given that the legal basis for many of the tariffs applied to China actually fall outside of the scope of this investigation. Of course, you do have the fentanyl and reciprocal tariffs coverage, which does cover some of the products, but you have all of the pre-existing Biden tariffs, for example, on electric vehicles, where you have the prohibitive 102.5% tariff that will remain. I think in terms of the reaction of other countries, we will actually see quite a lot of silence. I'm not sure we're going to have many speaking up in the first instance, because if you look at the composition of their trade with the US and the products that are affected, they're still going to be worried about their car exports. They're still going to be worried about their steel exports. They're still going to be worried about future tariffs on pharmaceuticals. So they're not necessarily going to want to provoke the president by suggesting that pre-existing deals need to be renegotiated.
And Sam, on that point, some countries did deals with the United States on getting themselves lower tariffs than the ones that were initially set out on so-called Liberation Day. And in exchange for that, they were supposed to invest into the United States. I guess all of that is now thrown into in some kind of disarray.
So it definitely is, but I'm not sure how many are going to be willing to articulate it. The one exception to that, and the one that I'm going to be watching the most, is the EU, insofar as the EU still needs to implement its own commitments under the deal it's undertaken with the United States, by which I mean it needs to remove tariffs on US exports to the EU. And that's being held up at the moment because it's going through the legislative process and you have the European Parliament involved. And I suspect that if the legal basis for the Trump tariffs are struck down, we're going to see quite a lot of European parliamentarians and politicians being quite vocal and hostile to the idea of following through on its own commitments. So in the first instance, that's the deal I'm most concerned about. That I don't expect, for example, the UK, Japan or South Korea to be raising the same sorts of questions straight away.
OK, that's interesting. We'll certainly watch that. And we've spent a lot of time on this programme and talking about tariffs and what the Trump administration has done on that front so far. But you flagged to us another phenomenon around trade that's really interesting between the US and the rest of the world, and that is an increase in enforcement activity, and in particular implementing rules around rules of origin. I mean, what is the size and the sort of scope of that uptick in enforcement that we've seen there?
So at the moment, I'm sort of working under the assumption that many of the products entering the US are not necessarily doing so under the correct origin provisions, under the correct HS code, under the correct valuation. And this is largely going to be accidental due to the fact we've had different differential tariffs imposed across different product segments and across different countries. But one of the routes towards the US making this more painful for countries is just to ramp up enforcement, actually start asking, where is your product actually from? And once you delve into that, it becomes quite a tricky question, because the rules around this are very nebulous. They're not necessarily clear-cut. I sometimes describe them as vibes-based. It can become quite easy to determine that a car you thought was from the UK is actually from China, or for some pharmaceutical products you thought were from Europe are actually from India. So those enforcement actions have already been ramping up over the last year, and I expect that to continue and to impose new pain on importers.
Sam, what would your advice be to one of these 1,000 companies that signed up to this legal case that is now with the Supreme Court?
Well, I think you had to. I mean, because this whole question around rebates is entirely up in the air. It could be that the Supreme Court judgment says something about it and provides some guidance. My suspicion is that it's not going to be particularly easy to get this money back. You just sort of think they're not going to sort of allow you to just tick a box. It's not going to be automatic. You're going to have to go through some process. So I think for all of these companies, ensuring that you have followed all of the correct provisions in the run-up to the decision is essential. But I also think that there could be political pressure placed on companies not to avail themselves of the rebates. And it'll be interesting to see how, that is articulated. We've already seen this in the case, Trump does lash out against individual companies. We've seen this in the context of the Venezuela discussion, for example. So there could be some pressure there. Then there's also the question, of course, of who these rebates accrue to. Obviously, it's the person who paid the tariffs, and that is, the importer. But actually, contractually, that can be quite messy. So it's not necessarily the case that the company that exported the product is going to receive any benefit in the first instance, and working out who exactly benefits and if they are able to get the rebate is not clear cut at all.
And your advice to a sovereign government that is in the process of negotiating a trade deal with the Trump administration? I'm thinking of India, for example.
Yeah, calm insofar as this court case applies to a certain segment of tariffs. It, of course, does not apply to all of the tariffs. And I completely agree with Brendan that my assumption is the tariffs would largely be replaced using other mechanisms. So in a sense, you just should continue as normal. But, of course, in the back of your mind, it is going to have an impact, and it might determine what you are willing to give in return and how much you are willing to give. So I do think that it certainly is going to play a part, although I don't expect many governments to sort of be openly critical or shouting about it. I expect you're going to struggle to get a statement out of the UK government, for example. I expect you'll struggle to get a statement out of the Indian government in the first instance. It might be a bit easier if you go to the chair of the European Parliament's select committees.
OK. Valuable and smart insights. Sam Lowe, partner at Flint Global. We'll see if, of course, that ruling comes through from the Supreme Court today or if it's punted until June. Coming up, switching focus, because starting today, here's the number of the day then, and whether or not you can name that number, if that is the right verbiage. Starting today, how much more will non-Europeans have to pay to visit the Louvre? The answer when we come back. This is Bloomberg. Welcome back. Now, before the break, we asked, starting today, how much more will non-EU visitors have to pay to visit the Louvre in Paris, of course? The answer, €10. €10 more. That's tourists from the likes of not just the US and China, but also here in the UK as well. Another Brexit dividend, of course, will now have to pay €32 to enter the museum. That is a 45% increase from last year. The price hike expected to help raise millions of euros annually to fund an overhaul of the famous gallery. The degradation, of course, of the museum was flung into the spotlight back in October when that 4-person gang stole jewellery worth $102 million and fled within minutes. I'm not sure how much of that they have managed to reclaim and re-find, but there we go. Higher prices at the Louvre, Anna.
That was audacious, wasn't it, that particular theft? Well, let us, if you're not off looking at cultural museums and galleries, what is on the docket for the trading day ahead? Let's have a look at that, shall we? US PPI, US retail sales, we get bank earnings, of course, Citi, Wells Fargo and the like. The Supreme Court opinions, they might give us a view on trade, they might not. We're also focused on Fed speakers and Denmark, Greenland, foreign ministers of those two countries meeting with Marco Rubio and also with JD Vance. That happening in DC. So we'll keep an eye on that. But the bank earnings story is certainly going to be front and centre.
It was amazing. Yeah, it was amazing yesterday. Actually, the CPI number was reasonably benign. The market kind of brushed past it, but it was JPMorgan's numbers that really kind of moved things around a little bit. I'm going to continue with that trend as we work our way throughout the rest of the day. JPMorgan out yesterday. Then we get across to it. Is that a disappointment? Yeah, it was probably. President Trump certainly ratcheting up the rhetoric on credit cards as well, which was fascinating too. He's not backing down on that story. So what do we get today? And are we going to get a similar story to what we got yesterday? Let's find out. Charlie Wells is here.
Guy, the setup is negative. If you take a look at the screen, there is a lot of red here. And this is not what analysts had been expecting, given the banking rally that we have seen over the past few months. A lot of negativity here connected to those JPMorgan earnings you're talking about. A disappointing print on the deal-making front, on those investment banking fees. That sent some shivers through the market that you can see here. But there are some factors as these other banks start to report to pay attention to. I think one in particular is trading. That was actually an area where JPMorgan over-delivered. We're expecting some growth here at a lot of these banks as well. You're seeing some negativity here on Citigroup, on Morgan Stanley. A lot of that is connected to difficult comparisons from the year prior. So this could be something of a ballast for the industry. We've also got to think about net interest income. So we've been hearing a lot of kind of short-term noise about some policies that may or may not be coming into effect. But one of the points of this trend that analysts have been talking about is banks growing their loan books, really expanding their balance sheets. And that has a positive effect on net interest income. We saw that have a positive effect on JPMorgan. Let's look out for that as these banks start reporting later today, that long-term trend.
OK, so there's all the dynamics of the earnings stories there. And there's also the shifting tone we're seeing from the White House and the attention that the White House is giving to the banking sector, if we can put it that way. So what does that mean for the performance of the banking sector then, Charlie? It's not had a bad time. Might times be changing?
It's had a very good time. If you take a look over the past year, really outperforming that banking industry, outperforming the broader market. And I think a lot of questions here are related to that shift in tone, because banks on the back of that Trump victory really had been in an environment that was more positive for them on a capital front, on a regulatory front, M&A as well, and also on that AI front, right? This is a narrative we haven't heard so much about, but the concern is that there could be some steam taken out of that. And so when you look at what's happened more recently, you see that KBW Bank index of major lenders inching down a little bit. This is the key question. And as we get more data, we'll have more answers on, is this a long-term trend upward, or are we starting to see that fizzle out?
OK. Charlie, another busy day for Charlie Wells. Thank you very much indeed for the coverage thus far. Charlie Wells on what we're seeing with the banking sector. It's a busy day. There's so much that potentially could upend these markets. There's a lot of macro news coming through. There's a lot of things that we need to be focusing on. Let's figure out what else we should be looking at. Market Live's Skylar Montgomery-Koenig joining us now. Skylar, today looks like a really fascinating... The back end of today's session looks really fascinating. You've got US data, you've got US banks, you've got this trade story which could emerge. Do I just sit on my hands and wait for the... How do you trade a day like today?
Yeah, I mean, in all honesty, I don't think the data is going to matter that much today. I think we're more looking for signals from the banks. I mean, mostly on bank earnings, I'm watching for what it says about the consumer and the economy in turn from that, because that's what we really care about right now, right? We care more about the labor market story when it comes to the Fed than we care about the inflation story. Now, last earnings season, it was overshadowed by a couple of small bankruptcies, as well as these kind of comments we got from Jamie Dimon around cockroaches within the credit market. And I'm worried this time around we're being overshadowed again by the headlines around credit card fees. But I think generally what we got last time was an economy on strong footing in terms of business bankruptcies were generally pretty healthy. Loan growth had bounced, signaling that banks were relatively optimistic. and loan loss provisions were largely unchanged. That means that they're at healthy levels, and so they're signaling banks are ready to absorb potential losses, but aren't excessively worried. So those are kind of the metrics I'll be watching for throughout this week, including with this afternoon's earnings in the U.S. And, that will really be the update on the U.S. consumer, as well as we'll get retail sales, which will be interesting from that perspective.
Skylar, what for you is the clearest signal that this toppling of records in the metal space is spending or is sending to these markets?
I think it's sending maybe 2 or 3 in terms of, I think it's fully in part a structural shift in demand, as in, especially with gold, you get these cycles where central bank demand shifts from being negative to positive, which we're seeing, which lasts a very long time. And they're representative of this change that's both structural in nature as well as strategic in terms of, yes, it makes sense to have more reserves in gold if you're worried about the dollar being used as a weapon, but also, central banks like those out of China or EMs, historically, they've had below average gold reserve. So that just has to build up, and that's going to continue. But I also think it's representative of the fact that there aren't a lot of hedges in this market. It also doesn't make sense to be short risk, because if you have a positive growth outlook, in positive years, equities rise something like 70% on average. So you can't be negative risk, but you want some kind of hedge. And the clear way to do that is with real assets, and gold in particular.
OK, what are you expecting from the Supreme Court, Skylar? If we make the assumption that they shoot down the IEEPA tariffs in some way, is this positive stocks? Does it send yields higher? What are you thinking the market reaction might be?
It's interesting because the commentary I've seen is that it'll be positive for stocks because it's positive for growth, with the idea being that tariffs are weighing on growth, so if you remove them, then it's a growth positive. So that might be the initial kind of charge you get, especially because the growth outlook is more positive this year in general. I think I'm more worried, though, by the idea that it also means that you get more deterioration in the deficit, because you were getting revenues from these tariffs. That will in part depend on, how does it get paid back? But that's kind of a conflicting factor to it. I will say, though, that yes, an immediate reaction is expected, probably to the extent that it depends on what the details actually are. But I also think it's broadly accepted that there will be some form of tariff. So whether that shifts to being sectoral tariffs versus kind of high-level IEEPA tariffs, it doesn't mean that revenue is going away permanently. Yep. It just means it'll be implemented in a different way.
OK, Bloomberg Markets Live, Skylar Montgomery-Coney. Skylar, thank you. We're also watching lines coming through in the last few minutes from Japan's finance minister, trying to jawbone the currency a little bit, but not to much effect.
The other risks out there today are, and there are so many, the Iran story, which I think Trump's going to respond to at some point. Yen intervention risk is definitely a risk out there as well. The market's not positioned that aggressively for that. So there's just so many risks
Marco
in today's
Rubio,
session.
Greenland.
Yeah, watching the Greenland story, because if it brings in the rest of Europe, that starts to gain momentum as well. Wells Fargo CFO, 8 p.m. London time. Don't miss that conversation. That will be a focus for us later. That's it for the opening trade. The Pulse is next. This is Bloomberg.